afternoon, everyone. Happy New Year. This is Anthony Alak with Torrey Hills Capital. Welcome to the Millennial Precious Metals webcast for January 17th, 2023. Hope everyone's doing well, and thanks for taking the time to join our virtual lunch. Many of you are already familiar with Millennial Precious Metals, having been introduced to the company almost 10 months ago. Many of you are shareholders. But a lot has happened in that time. The management team at Millennial has done an excellent job of de-risking its key assets, and we are happy to have them on today to discuss recent developments and the outlook for 2023 and beyond. As a quick refresher, Millennial Precious Metals is a Nevada-based exploration company with 7 properties in Nevada and 1 in Arizona. The company has been engaged in an aggressive drill program at its key assets with a PEA expected this year. And we feel that the company is well positioned to be a multi-million ounce producer. The company trades on the OTC market under the ticker PMF and on the TSX Venture under the ticker MPM. It's currently trading with a market cap of about 30 million US. And we feel that the company, with its strong balance sheet, high percentage of institutional and insider ownership, and the fact that it's trading at a discount to its peers, that there is plenty of upside in the stock as the company continues to execute its strategy. With us today to discuss Millennial Precious Metals operations and growth strategy going forward is the company's president and CEO, Jason Kosec, and the company's VP of Corporate Development, Jason Banducci. It's great to have you both on today. Thanks for taking the time to bring our viewers up to speed on Millennial Precious Metals. It's obvious a lot of exciting developments are happening with the company, and I'm happy to have you share those with the group. Before I turn it over to Jason, I just want to mention that if you have any questions during the presentation, just simply type it into the Q&A or chat box, and we'll make sure it gets answered. So with that said, Jason Kosec, I'm going to turn it over to you. The floor is yours.
Awesome. Thank you very much, Anthony, and thanks for everyone for joining today. Much appreciated. Today, I'm really going to touch on recent trading history. We can go into what we did last year quickly, but the focus is going to be on the recent trading and where we're really building value in the 2023 season. Okay, so if anyone has any kind of wants to go into more detail, feel free to ask questions or listen to any of the previous webcasts. Okay. We will be making forward-looking statements, so the full disclaimer is on our company website. I encourage you to go there. Really what we're doing here is exactly what Anthony said, is building a multi-million ounce, multi-project heap leach company focusing on near surface heap leachable ounces. And why that is they're extremely low capex, very high margin, and your cost per discoverable ounce is extremely low, which equates to, we could focus on share price appreciation instead of market cap appreciation and return value to all of our stakeholders. Everyone I think knows this. What we'll really touch on today is Mountain View and Wildcat. Like I said, Red Canyon, and we'll touch on that too, is an amazing drill bit story. Some of the most significant intercepts drilled globally in 2021. And those are things in the portfolio that give you optionality and added torque to a development company, because really what you're only paying for is Mountain View and Wildcat. I think it's very important to understand that in this business, it's not just about adding ounces in a systematic scientific manner. It is also about risk mitigation. And most junior companies forget about that. And the program in 2022, as most of you know, was really designed to remove all of these risks, okay? One of them, obviously, that is a showstopper is the metallurgy, okay? We did over 160 bottle rolls, 20 columns, 6,000 cyanide shakes, did over 2,500 kilograms of material. You will see those metallurgical results start to trickle out. We are more than happy with the results, and they are better than what we are modeling internally, okay? The other one is the geotech. So how steep can we design the pit walls, which has an impact on the strip? Again, better than we expected, much better than we expected internally. Resource conversion is always key to see the continuity when you're going from inferred to indicated. The conversion rate, I'll tell you, in orogenic systems, you're lucky to get 50%. Here we're well above 80%, which is very significant. And lastly, what we'll touch on, especially with Wildcat, because it's very easy to show scalability, is really how big can this project really be, okay? And how much blue sky can we see just with Wildcat and Mountain View? And we'll touch on that today. I'm not going to touch on the team. I think everyone's familiar with that, but we have 3 PhD geologists, mining engineers that have built the biggest gold mine in Canada, and 2 kind of MBA and Masters of Science people on our team. All right, so right now 8.5 in the bank. Really good following from the sales side. Jason Banducci will more than willingly send you any of the research reports if anyone wants to read them. Okay, so the key thing is that when we built this company, 6 of the projects came from Waterton, which is a private equity firm out of Toronto. Okay. The way we structured the deal is they got 19.9 pro forma and some cash. Now, the way private equity firms work is usually they have a 9-year investment horizon. Okay, so it's 3 years to invest, 3 years to harvest, 3 years to flip. That is their model. Okay, Waterton, that fund is closing down. They own a lot of equity positions in a lot of other companies. Us, we wanted to be very proactive in placing those shares into key supportive institutional shareholders and high net worth people. And on November 11th, we crossed that last block. So they are now completely out. Okay. The other thing that people may have seen is last week we traded almost 17 million shares in one day. Okay, we were the largest volume on the TSX Venture. What that was it was Crescat, a fund out of Denver. We spoke to them after they had already blown out 10 million shares. We caught it quite quickly because it was going through a direct market access and clearing through Canaccord. We called them up, crossed the remaining 13.7 million shares with one institution. Why they did that, I want to, just so everyone is clear, is they were super excited about Red Canyon. And Red Canyon is an amazing story, okay? It has the potential to be something world-class. When you're in the same rocks as the Cortez complex, the same intrusive rocks that date at 35.5, you're, like I said, 35 kilometers south of the Cortez complex. You sit on the same fault system. Now, that being said, that is a high risk, high reward project. And strategically, from our strategy internally, is that when we can show significant resource growth on low-hanging fruit marginal to our current resource, that can create significant value both at the PEA level and the updated resource once we have the exploration plan of operations. In this market, as much as I'm an exploration guy and I love doing that, to allocate capital in a respectable manner and to return value to shareholders in a very pragmatic way, we thought that focusing on Wildcat and Mountain View, getting the PEA out, re-rating to our peer group that trades at 0.3 to 0.5 NAV. We currently trade at 0.12, 0.13. So there's a significant re-rating opportunity. And as we see the gold tape climb and with wind on our back, we will go look at that. They were not patient enough. That's why they got out of the story. Nothing to do with any of the assets. It was our strategy. That being said, since the Waterton block was cleared, over 43 million shares have traded since November 14th to January 17th, okay? Including the Waterton block, we've traded almost 60 million shares. Okay. You've basically turned over the entire float of the company in a matter of, call it, 2 months, which is significant. The floor is in. This is a very clean story, and we appreciate anyone who's been in there supporting us throughout the way. To get rid of these, to clean it up like this was an amazing thing to do, and to see that support and to see that volume and be up significantly off the floor with some major catalysts along the way and cash in the bank. I think 2023 season is really primed to return value to all you shareholders out there.
And I think, Jay, also important to note, if you look at the key institutions that we've got logos on for in this presentation, all those key shareholders have not sold a share. They stood strong and they supported us. We had calls with them last week when we had 16 million shares trading in a day. They're there, they're supportive, and their average costs are significantly higher than what we're seeing in the market right now. And that's reflective of Jason and my share position as well, right? We've been supporting the stock the whole way through. We've seen the whole float clean up in the last few weeks, but everyone's in, and all the strategic investors who have big positions are all in for the long term and are all in at a much higher share price.
Yeah, that's a good point. If I wasn't in blackout, I'd be, because of the PEA, I would be in the market. But the last chunk of stock, $70,000 that I put in, was, I believe, at like 58 or 60 cents. And the cost base for those institutions that you see there is probably around 40 cents. Okay. I'll get quickly into Wildcat. Again, we've already discussed what the project was designed to do. You can see here clearly, this is the old pit shell, and then the new pit shell, the oxidation profile, is the line below it. Okay. The other thing too is, every time we try and step out to drill for the pit wall, the geotech hole, we keep on hitting mineralization. 30 meters of 0.3, 55 meters of 0.4, and as you can see here, there is literally no strip, and that is the key metric, and we'll touch on that later on. Everyone says grade is king. Okay, grade is great, but margin is king. So when you're talking grades at 0.4, but there's no strip, you got to factor that in. So we'll, like I said, we'll touch on it later on in the presentation, but that's really that unique combination of grade to strip really drives the economics. What you see here, and what we did to show really where this is going, okay, maybe it's better to do it with my laser because it gets kind of messy. Let me get the laser. So this green circle, these green circles with the black outline, is the current pit shell. Okay. What we did, because it's important to know, in Nevada, there's two types of permits. You have a notice of operation, which gives you 5 acres of disturbance. And that's the only permit that's ever been on this project. What we've just submitted, and you saw the press release, is an exploration plan of operations, which gives us 400 acres and over 1,000 pads of disturbance. What we did to show the market where this is going is we did a very detailed mapping and sampling program. So this orange rock you see here and on this cross section over here is basically a volcanic, fragmental volcanic rock. Okay. So we've mapped and sampled everywhere outside of the pit. So where I'm highlighting now, right now, all of those samples are completely out of the resource. All these samples over here are all outside the resource. So there is significant low-hanging fruit that it comes right to surface. It's just putting the rig right on it. And unfortunately, because of the disturbance, we couldn't do that over the old drill program. The other thing that's very important, that is can be a significant game changer to this project is the type of volcanic rock that we're talking about, this orange rock, is very close to the, basically what happens is you have a diatreme vent. So think about it as a volcano erupts and then puts all this volcanic rock on this green rock. This is a Cretaceous diorite, so it's much older than this orange rock. The only place to hide a big vent like that would be under this purple rock. That purple rock is a post-mineral basalt, so forming after mineralization. So it's covering the deposit, okay, most of the deposit. And there is only one hole or a few holes in there, just 2 or 3 holes in there, go through 20 meters, 30 meters of post-mineral basalt, and then you're basically right back into this orange rock, okay? And it's, 50 to 100 meters of 0.5 to a gram. The game changer could be significantly, though, is the way these low solvations epithermals form is you have high-grade mineralization marginal to on the walls of the vent, okay? That's where how these things significantly change your ounce profile. The other thing too is that what's feeding the mineralization underneath the pit is because the diorite is older and more robust. When you go from compression to extension, that rock will actually crack, creating these veins and the fluids to migrate up. And then because the orange rock, which is this fragmental volcanic rock, has a lot of porosity and permeability, it'll create this disseminated ore zone in the upper layer. And then you get these higher grade veins that are feeding the fluid. These veins have never been drilled. Down in the valley, though, this orange rock has been removed. And the old timers in the 1900s we're mining out these veins at 1 ounce to 2 ounces per ton. So we know those exist. So not only is there low-hanging fruit at surface to significantly grow the resource, we've grown the surface footprint by, it used to be 1.5 by 1.5, now we're at 3 by 2, okay? Not only can we grow the open pit in surface mineralization, the potential for high grade, 10 to ounce plus per ton is very probable. Now we got to go drill that, and that's something we will be looking at in the 2023 season. But like I said, you don't want to allocate capital to drill, do a bigger drill program until you've removed the key risks, because you can go drill out everything you want, but if your metallurgy is only 50, 40, 30%, well, then those ounces aren't economic. If your conversion rate is 50%, well, that's not going to work because your cost per discoverable ounce is going to be extremely high. So the way we're very pragmatic about that is remove key risks, which we've done, and you will see how good those results are in the coming months. And then we show by the surface and start drilling and growing the resource that way. Okay.
Just highlight that we're not limited. Like, we don't have to wait until we get the exploration plan of operations. That's going to allow us to do a significantly expanded exploration program, but we do have flexibility under the current plan of operations. I believe we've got just over 1 acre of surface disturbance. We've got 30 pads already constructed. So again, once we have that exploration plan in hand, that allows us to significantly step out. But look, if we want to, in the second half of the year, we can go back and drill under the current plan and still show resource upside.
Yeah, correct. And, just so everyone, right now that EPO, the exploration plan of operations, is with the government, and they say 6 to 9 months. But as Banducci mentioned, under the NOI, we have 1.2 acres left and 30 pads already constructed. Mountain View, like I said, very same program. The beauty is that we finally understand the controls of mineralization. What's happening is a lot like the Sleeper deposit, which was a beautiful discovery back in the 80s. What's controlling it is you have a high grade breccia that's basically mineralizing this rhyolite. The met work, there was no met work done here previously. And to be honest with everyone, that gave me a lot of sleepless nights. We will be putting that Mountain View met work will be coming out very soon. And it's probably some of the best metallurgical results for heap leach I've seen to date. Okay. So we're very happy about that. The system is completely opened, both into the basin and to the northwest. Our last hole intersected almost 40 meters of 4 grams, 100 meters outside the pit. And we know it's completely open to the northwest and to the west and obviously at depth. Okay. Quickly, this is what we're talking about. Okay. Top 1% of drill holes drilled globally. Okay. And these are oxide houses in Nevada, and the remainder were in the top 10%. So that's why Kosec got excited. And believe me, we understand what's controlling the mineralization. Basically, it's a really high grade zone right in here that then plunges like a cigar into the page and at us. So now we understand the controls, we understand the stratigraphy, we know where to put the holes. It is just balancing capital allocation in a meaningful manner is what we're looking at. And this is really what I'm talking about. Okay, is that it's important to know that grade is great. Don't get me wrong, but it just comes down to margin, like any other business in the world. Okay. So when you do the grade divided by the strip, so the strip is how much waste do I have to remove? How much waste do I have to truck, blast, manage to get to my ore? Okay. And when you do that, Millennial has the highest effective grade in Nevada. Railroad, which Orla bought last year, they're at 1.3 million ounces. We're at 1.2, and we will grow that this year. They were purchased last year for $232 million.
And that's in a bad market.
Exactly. So you could see the difference on the strip adjusted grade. And we're at 1.2 right now, and we will grow that substantially this year. And once we get the plan of operations, we can really grow the resource. Okay. And, when you go through this list, there's a severe scarcity of these projects because of their high margin nature. Okay. So Hasbrook is 50% owned by Sun Valley. So it's a private company. It's basically gone. Northern Bullfrog's gone. Pan is gone. Florida Canyon is owned by Argonaut, bigger company. Round Mountain is Kinross, Mother Lode gone, Railroad gone, Relief Canyon, bigger producing company. Gold Bar is McEwen, Marigold is SSR, and Gold Rock gone. So you go through this list, we're the last one. And people say, okay, why is that? How can this be? The reality is that these projects have not had capital or intellectual allocation, since the 80s. Okay. Since LAC Minerals.
And there's a significant, look, we took on a significant amount of risk when we bought the projects. And, like you said, it's risk reward. And if you're buying Millennial now at 20, 25 cents, there's a significant amount of upside, especially assuming that, we're going to be removing those 4 big key risks that can kill these projects that will. Doesn't matter if you've got 1 million or 2 million ounces. If the met doesn't work and there's no scalability, it's a zero, right? And so we're going to be removing those risks this year, which is going to allow us to get a near-term re-rating once the PEA comes out, because we'll show that there's an economic project there. Then there's another opportunity for re-rate once we show growth, right? And then, we don't have a slide in here, but there's a clear advantage from a value perspective of getting a mining permit. You look back at the projects that have traded over the last 2-3 years, you get almost 2 times the value for a permitted project. And that's why we're spending all of our time, effort, and focus right now on moving Mountain View and Wildcat towards essentially towards a production decision or towards a mining permit.
Yeah. So, yeah, for everyone out there, permitted ounces in Nevada go for 0.89 on a PNAV consensus basis. Okay. That's where we build value. Okay. Is yes, resource growth and exploration is great, but right now we trade at 0.12, 0.13, average 0.89. That's where we make money together. On an EV ounce basis, acquisition cost is 90. We're at 17. This is how we build value as an exploration and development company. Okay.
And then it's at that point when we trade at the point, 6 times NAV, that we can then raise capital to go drill high risk projects like Red Canyon.
Exactly. So you don't take the dilution down here is our strategy. Okay. And lastly, we believe in systematic, scientific, but aggressive exploration because time will kill companies. Okay. We've raised close to just over $40 million. We've built a team. We've submitted the EPO. We've had a significant drill program, gone public on 2 exchanges. We'll have the PEA out and the updated resource in Q2, and then continue the studies for the mine plan of operations, which will be submitted in the middle of 2024. And that's where you get that 0.89 valuation once the mine plan is submitted. And the beauty thing here is that with Wildcat, because there's no pit lake and because there's no waste rock, it will not trigger an EIS. So the permitting is much quicker because we can permit it under an EA than any other project. And then lastly, obviously, the upside that you don't pay for, Red Canyon and Sierra Colorado are really exciting stories. And I guess, to make everyone feel comfortable here, the reason why we're, 55% institutionally held by the biggest funds globally is because we've done this 7 times. So they know that we're doing the proper work. Because of the 7, 5 of those projects are in production today. We've put up over 60 million ounces of discovery, our team. And like I said, after the recent trading, 60 million shares in 2 months to turn over the entire float with gold at our back and some major catalysts with the resource PEA in phase 2 of drilling at Wildcat. This is really primed to really move in this market. That's all I got for everyone. So please, I'll open the floor up for questions.
Jay, I'm just going to jump in. One thing that I think we should highlight, and I know, obviously anyone on the call knows that we're always in touch and happy to touch with current shareholders, prospective shareholders. But, I think there was some chatter, I don't know if it was last week or the week before, about, potential financing coming, and that's why people were selling the stock. And so, Jay, I think it would be good to just talk about the difference between how we were budgeting and spending last year versus what that looks like this year and what the focus on this year compared to last year, and how, it's not, you can't look at the cash burn last year and apply the same to this year, because what we're doing is completely different, and we've slimmed down the team. Like, you're basically looking at 50% of the management team is on this call, right? It's interesting because, we've looked at a lot of other companies from an M&A perspective, just to get a sense of, who's out there, what kind of projects out there, how are other people running their exploration development companies. And I've got to say, we probably have the most lean team on the street, right? Yeah. So we're managing it. We're very careful, especially in this market. Yeah, we've got a bit of a tailwind here, but we're being very careful with marketing budget, any of that kind of stuff. But there is no financing coming, and Jay will provide a bit more commentary on some of the activities and spend this year.
Yeah, that's a good point. So I guess there is chat, because we always monitor things in all these chat rooms to see what people are discussing, And someone, I guess, compared our 2022 burn in the first and second quarter to this year. Okay. And that is completely different. Last year, we had 3 rigs going. We had a gazillion consultants doing all the baseline work and the engineering work, and all that has been done and paid for. Okay. So we're at a point now where it's literally finalizing the key inputs for the PEA and report writing. So our burn is can drop significantly. Okay. So you can't even compare the two. The other thing too is that, it's great we have a tailwind here, but now that we have the key inputs to the economic study is royalty companies. I come from that background. You can get money between 0.5 and 0.7 on a PNAP basis. Okay, and okay, if we still trade at 0.13, well, are we gonna go out and raise equity at 0.13, or are we gonna take a royalty at 0.5, 0.7? Well, you're gonna take that arbitrage all day. And as the largest individual shareholder, I put over 700 grand of my own capital into this thing. If I was Richard Warwick, that's fuel for my jet for a month. But at 35, that's a significant chunk for me. And so I'm very cognizant about dilution. So everything we can do to focus on share price appreciation is one of our key values.
Yeah, thanks for clarifying that. And again, we have a couple of questions in queue, but if you have any questions, please feel free to ask. Type it into the Q&A or chat box. If you can't do that, raise your hand and I'll unmute your microphone. So let's just go down here, rapid fire. So this question came up as you were touching on it about monthly burn rate versus cash on hand. What do you think this cash that you have on hand can get you through in terms of milestones?
It can basically get us into the second half of 2023. So we can get through pretty much everything.
Yeah. And I think too that as we were discussing before the call, the sentiment out there is changing a lot. We speak to mining companies all the time, and I think that the sentiment is much more positive than it was a few months back. And I think the ability to raise money is a lot easier than it was 5 or 6 months ago. But I have to say that Jason K and Jason B have done a great job of managing the funds and keeping the burn rate under control.
The reality, I may just touch on one thing there, Anthony. You're seeing the kind of the big boys and mid tiers starting to move quickly, okay? Because you're at, over 1900. And, as soon as those guys start trading at 0.8, 1 times NAV, guys recycle that capital back to companies like us that are in safe jurisdictions, that are trading at 0.13, that have cash in the bank. They'll bring those up to 0.5, 0.7, then pull, and that's how the capital cycles in the space. So, you've seen moves already, and it's key to, okay, fine. Some people may have caught that, in the recycle of capital is what we're going to see here very quickly. And like I said, when you've moved 60 million shares and pretty much the entire float, and you got gold moving, this is where capital goes quickly.
Yeah, and it was great to see that that was Kosec selling was completely absorbed. I think that's a really good sign. One of the questions we got were, how do the next 3 months look for the company? So I guess what can we expect in terms of any news flow or anything that's coming over the next few months?
Yeah, so like I said, it's going to be the network. We will the resource, the PEA, and we'll probably show all the target generation work we have done for Ocelot, Red Canyon, and Cerro Colorado.
Okay, great. Hard to come up with any questions with such a great presentation. Hit on everything that I'd want to know to add to my position at these levels. Keep up the good work, J&J. That's from your friend Robert B down in Miami, who is a big supporter of the company. So can you go back to the announcement on 1/5 of the EPO? Is there any way you can show the scope of this expansion and when we can expect drill results from that? Is that
So I don't have a slide here, but whoever's asking that question, please send us an email and I will show you the how big the EPO boundary is.
Well,
Okay.
you can basically draw it, right? It's if you go back a slide and you
No,
show.
you can't, it's way bigger than that. So put it this way, the project area is 17,000 acres and the EPO boundary is 14,000 acres. It covers pretty much the entire property.
Yeah.
And okay, some people may say, Jay, why did you go so big? Because it costs more money. The reality is that EPO costs us for Wildcat, $1.5 million. And why we did it so big is because we can now build the baseline work for the mine plan of operations. So you pay it forward, and then you're not constantly going out and amending your EPO boundary. Like you see Liberty, they've had to amend their EPO boundary, I think 2 or 3 times now. And each time you do it, it takes 12 months. Okay. Mm-hmm. So strategically, we said, you know what? Let's do the whole thing, cover even the areas of the leach pads, so we can build all that baseline work and gather all that data, not only for the exploration, so the EPO, but for the MPO, the mine plan of operations. Okay. So that's why we did it. And same thing for Mountain View. Okay. Is go above and beyond, get the work done so that we're not confined to a space or amending things down the road. And that was our strategy from day one.
Is the cost of that EPO filing reflected in your current cash?
Yeah, all that EPO is work is done.
Okay, great.
Again, that's why you're burning cash last year, because you want this stuff to happen quickly and you want to drill quickly. None of this stuff is cheap. And, the other side of the coin is Nevada is one of the most expensive places to drill, right? But you want to get that premium multiple being in a tier 1 jurisdiction. And like Jay said, we're going to show resource growth. We're going to remove all the key risks. And this is all in the best jurisdiction in the world. And, we still get inbounds from mining companies that have zero NAV exposure to the US that now more than ever are continuing to look, right? So we're in the right part of the world, especially in a bull market.
Yeah.
This question just came in. How much of the effect does the fluctuation in the gold price have on your business at this point?
I will show you that right now. There you go. So the way we build companies, okay, is that in any gold market, in any price environment, when you're looking at this, for example, at $1,600 gold, strip adjusted in situ value, okay, at 1,600, that rock is worth, $22. Our cost is, $11. Well, the average cost, okay, in Nevada will come below that. So, you're still at a 50% margin. Okay. And that's why these oxide high margin projects have serious torque when you're sitting up here or up here. And I think we're all in the belief that given the macro view of the world, and we could talk about people getting off the petrodollar and going into the ruble, renminbi, and won, and those being backed by gold. all those things are unfolding as we speak. And again, people want NAV exposure to literally the number one mining jurisdiction in the world. Everyone says tier one, and that kind of drives me nuts, but Nevada is number one ranked by the Fraser Institute in the world.
Yeah, and there's no doubt that gold is setting up right here for a move upward, and it was tough last year, especially when rates started going up and the dollar started strengthening. But I think we're definitely kind of at that point where gold. I mean, I've seen some pretty crazy projections for gold, some as high as 3,000 an ounce. I don't think we're going to get there, but I think we're definitely going to get to at least 2,000 an ounce for sure.
But I think it's like, and even back to that last question, right? How does gold affect our business? Well, it affects the margin that we've got for the ounces in the ground, but it also, as this gold market continues to strengthen, and that happens with as Jason said, the macro backdrop. But once you start to see the funds flow back into these equities, they'll move like this.
Mhm.
Right? We've seen it many, many times. And you look, you read any investment book, when's the best time to buy is when everyone else is scared. And everyone else is starting to become less scared. Right. And you're seeing that, like, we're talking about some of the larger cap, lower risk names start to move. But when it does move, and when that capital cycles back down into the juniors and the developers, it's going to happen faster than you can imagine. And so it's all about positioning now. And we've seen it as far as we talk to the investment banks and the sales desks, and they're starting to get those questions again. Which gold names do you like? What are you guys seeing? And so that gives us hope that this shift's going to happen soon, and we think we're really well positioned to take advantage of that.
Yeah, I would definitely agree with that, because Tory Hills we've been in resources for a long, long time. And we've seen kind of this shift happen before. When things are bad, they're bad, but when they're good, it happens very quickly. And it's a really great opportunity to look at stocks when they're down at these levels, especially with all the great things that you guys have going on right now. It's the reason I became a shareholder.
Your timing could be really good, Anthony.
Anthony, back in December, I was talking to the BMO desk, and they did a study where 65% of the venture companies are under $2 million. That was in December. So, that's the other thing too, is that, okay, we get a run. Well, all these guys have been waiting at the to get to the trough to do a financing. And they're doing, you see these companies doing like $500,000, $1 million financings, like just to keep the lights on. And that's the beauty that, we hit the market in April or May last year when people thought it was going to turn, and we saw it going into the summer. I'm like, ooh, I don't know. And did that financing, back at 40 cents, which was great because it gives us a longer runway to get through this and get that re-rating, because there's not that financing overhang. Whereas 65% have that problem.
Yeah, for sure. And I see it all the time, and looking at news releases where privates, or where financings are done for under $1 million. And, the way you guys timed it last year was perfect timing. It really set you up for, to hit some major milestones. Have you been approached, or would you consider a JV agreement or any sale of properties at this point?
Yeah, we are looking at JVing the exploration projects. So like Dune, Eden, Mar, Oslo, Sierra Colorado, Red Canyon. It just hurts because you know where to put the drill rig.
Yeah.
We've done it in other companies where, okay, the projects are so big, you don't really know, and it's going to cost a lot of money to prove your geological hypothesis right or wrong. Okay. And we're here at Red Canyon or Oslo, little less so at Cerro Colorado, you know where to put the rig. And at that point, you're just like, do you want to give away so much value um, when you can answer the question yourself? So we're not too fussed about it, but yeah, we get a lot of inbounds on those three projects. And for the right type of deal, yeah, we're totally open to it.
Yeah, I know that Crescat was big on Red Canyon, and you're sitting on so many great properties that it might,
Like Red Canyon would be, for a junior company, that would justify a $30-40 million market cap alone.
yeah.
Okay. Same with Oslo, maybe like a 10-15, Cerro Colorado 10-15. Like those are what those would be worth in an exploration company. And here they are sitting in our portfolio, and we're a $40 million Canadian company.
Yeah. The value is there 100% for sure. I don't know what else to mention. We don't have any more questions at this point. So I think I'm going to wrap it up here. I want to thank you both for coming on today. There's so many great things happening with the company. I have to say, I mentioned it earlier. I became a shareholder of the company, and I'm going to continue to buy more shares. This is we look at a lot of different mining companies out there. We have a lot of mining companies as clients, but this for me is, I think, our best idea in the mining sector right now in terms of exploration company, and we feel that the market cap versus the market value of this company, there's a huge disconnect. And so we're really happy with the team. We're really happy with what they're doing and how they've managed so far. So I really encourage everyone to take a strong, hard look at the company, because there are a lot of great things happening. And I think 2023, you think, Jason, for 2023, the PEA is probably going to come in the next 4 months, 5 months?
Yeah, it'll be in the middle of Q2, somewhere in there. And like I said, we're the last input, we pulled the plot. We've stopped the met work. So we have 3 of the 4 done at Mountain View and 1 done at Wildcat. So we're just basically had to do the mass balance, and then just the report writing.
And how do you think that's going to change what you have so far in terms of ounces that you're looking at? I mean,
it just comes down to the economics, right? Like there's the NAV or the NPV when you run your discounted cash flow analysis changes with those recoveries. Okay, so when we model it, we're modeling 70, and I can tell you the network is better than that. Okay?
Yeah.
So when you look at those analyst reports, that's what they're modeling, and I believe the consensus is around 280 US of NAV, 300 US of NAV, and they're using, I believe, 70 to 75, depending on what shop you're looking at. So that impacts the NAV, which obviously then impacts the valuation and the re-rating that you get.
Yeah. So a lot of catalysts for this year. The EPO that's coming out toward the end of the year, the PEA that's expected, hopefully in Q2. And so, a lot of really great things to look forward to for 2023. I think it'll be a pivotal year for the company. So again, thanks to Jason Banducci and Jason Kosec for coming on today and bringing us up to speed on the company. Jason, any parting words before I wrap it up?
No, I appreciate everyone for tuning in today, and really thanks for the support and the patience that everyone has had, and onwards and upwards, and hope we all make money together.